I think it makes sense to go around and get a quick intro of what everyone's doing and your role at your company. Then we could start. Yeah.
Sure. Hey, everyone. You guys hear me? My name's Paul. I run the business development team at dYdX. We're a decentralized perpetuals exchange built on an application-specific blockchain using the Cosmos SDK and Tendermint or Comet BFT. We launched in November. To date, the dYdX chain has done about $60 billion in volume, $10 million in revenues. 100% of that is distributed to validators and stakers. So fully decentralized, full stack from the front end to the infrastructure.
Hi, my name is Jacob. I run growth and strategy for Aevo, which is a derivatives exchange. We do perpetuals and options. We are on the OP stack. We leverage Conduit for that. And we've recently grown from around like 20 to now hovering around 1 to 3 range of derivatives. And I think we're going to grow much more from here.
Hello, everyone. I'm Dan. I'm one of the co-founders of Risk Finance and also just a new product that we announced that is called 100X. Risk Finance is an options AMM on Arbitrum. It's actually the highest volume options AMM on Arbitrum, or like DeFi options protocol, not just AMM. We launched around the summer, and it's been pretty exciting. It was terrible at the beginning, no volatility. I remember the day we launched was like the lowest volatility ever in years. But then it obviously went up, and then we've done like over almost 200 million volume so far. So it's been great. We just announced a new project, as I said, that is called 100X. That is an order book based that we are about to launch on Blast as well, so different chain. And it's not live yet. It will be live in a couple of weeks, and it's going to be for different derivatives. So not just options, but also other type of derivatives.
Hello, everyone. My name is Simran Singh. I work at GSR, a leading crypto market maker. We provide token issuer liquidity, OTC, and I myself serve as a portfolio manager for some of our discretionary strategies.
Hey, everyone. My name is Joshua Lim. I started a firm called Arbelos. We're a principal trading firm that focuses on options specifically. We've been around for about 5 months, so pretty young as a firm, but started my crypto career, I guess, at Circle, and then I've been at a couple of the bigger sell-side desks. So mostly we work with like hedge funds and corporates, folks that need to access crypto derivatives in some way, and we provide it through multiple formats, either bilaterally with, like under an ISDA, or on exchange, blocks. Derivatives, obviously the dominant venue there. And then also through DeFi venues, of which we participate on a few of the ones on this panel. So, yeah.
Awesome. And then my name's Chris Newhouse. I'm a DeFi analyst at Cumberland Labs, Web3 and blockchain incubator backed by DRW and Cumberland. So we'll go ahead and just jump into some hot trading related topics. Feel free to answer. How are perps primarily being used right now? Is it for hedging, or is it hedging and risk management, or for speculation?
It's for speculation.
I think perps are being traded to farm protocol rewards and points.
I mean, we use it as a risk, actually. Like as an AMM, we use perps to hedge. But, that's probably a unique use case. We use GMX for that.
I would say short-term hedging, but by far retail speculation.
Got it. I mean, I think there's like two constituencies. There's like the people who are spot price sensitive but not funding sensitive, so people who are speculators effectively, and then there's people who are market neutral arbitrageurs, right? So the people who are, I guess, funding rate sensitive but not spot price sensitive because they're mostly hedged out. So, I mean, I think the market's like evolved to be pretty balanced across those two constituencies, yeah.
Got it. Yeah, that makes a lot of sense. Maybe for the protocols, what strategic considerations are driving DeFi protocols to expand into the perp markets? I know Aevo has the pre-launch token perps, which are awesome. What is the strategic considerations there to prioritize some of the perp features now over some of the options? And how do some of these choices align with the goals of the broader DeFi ecosystem?
So if I'm to understand your first part of the question, it's what are we doing to grow the protocol? Well, the primary thing that I worked on, which I think is pretty innovative, is if you look at all the collateral assets on derivatives exchanges, it's a spectrum. On one end, you have stable coins, USDT, USDC, and then on the other end, you have WBTC, ETH, etc. But then you have nothing in the middle, which is yield-bearing assets. And so we have the first yield-bearing stablecoin, stables-denominated asset. So you effectively earn 4 to 5% on your margin while you trade. So that's one thing I'm working on. I think that's a pretty good edge. It's a key unlock due to composability in DeFi. That's one thing I'm working on. Second thing I'm working on is, there's pretty minimal product differentiation at this point. And as my role doing strategy and growth, I think a lot of it is going to come from looking at the design space of game design of yield farming. I think it's pretty nascent. And so that's what I'm working on. I think the winners are going to be the ones who let users play the best games with token rewards from here.
Got it. Yeah, that makes a lot of sense. And then Paul and Dan, anything to add on your guys' side for how you guys are growing your protocol and expanding into DeFi?
Yeah, I think it's really important to look at what product features are uniquely enabled by DeFi. One thing dYdX is really excited about is new market listing. And as he mentioned, there's like pre-market launch. You can pretty much trade anything with a price feed, right? dYdX is trying to think of a world where you don't have to go through governance to list a token. I know that's pretty unique to dYdX, but a world where any asset that exists on any digital assets, AMM or across chain, would automatically spin up a market on dYdX. So we're launching in about 6 months a product called permissionless market listing, where using vaults you could pretty much trade any asset that launches on any exchange cross chain with leverage, as long as it does a certain amount of volume. Unique ways that we can bootstrap liquidity by having perpetual revenue incentives for market makers and institutions that come on early. I really think that that's super important, because these bull markets and cycles are driven by certain narratives, and you don't really know what those narratives are before the cycle. So if you could have a way where those markets are automatically listed on the exchange, then you could capture those narratives without really having to follow up behind the narrative, because you'll be there right when it launches. So that's something we're excited about.
Yeah, in our case, I would say options and perps are completely different beasts when it comes to the target audience. When you have a perp, your main goal is just to compete with the ecosystem in some way. Everyone is trying to differentiate themselves, right? So you see their vision, everyone is trying to get his angle, and I agree absolutely on the incentives. That's how you try to get, because people are already traders. They know how to use it. They just want to go to the one that they like the most for incentives, for being permissionless or whatever. When it comes to options, it's a completely different beast. With options, you still need to do a lot of education. You still need to make sure that people understand what's going on. You still need to decide if you're focusing retail, if you're focusing institutions, other protocols, because for example, in our case, we have a couple of integrations from other protocols. Reason, for example, why we love to be in other chains where we have an ecosystem, because it matters a lot when you trade options to have integrations with other protocols that use that for hedging or for other use cases, or whatever they do. So I think options and perps are completely different beasts when it comes to growth. One thing on the options is, as I mentioned, and I would like to stress out, is there is a lot of education to do around it. Maybe it's not even enough. There is still a lot of product development to do in terms of simplifying the option in a way that you can do. Ribbon started with structured products back in the days, that it was probably the only time that options were common in this industry. And so I think there is a lot of opportunities there to still, keep working on that as well. So one thing that we do, and even the new product that we're launching, is we still try to benefit from being on a chain. At our stage, we're still rather kind of new in the space, being on an ecosystem. For example, Arbitrum was great. Because of all the other protocols. Now we are, as I said, launching on Blast. Blast is also great because there is an entire ecosystem there that is growing. So there's a lot of composability opportunities. There is a lot of engagement from users. There is a lot of rewards from the chain itself. So I think that's a strategy as well in terms of BD, to try to attract new users and grow in the space, no matter if it's options or perps in this case.
Awesome. Yeah, and for this next question, I think we'll start with the institutions, then we'll get the perspective from the DeFi options protocols as well. So this recent move has been very institutionally led, very Bitcoin and ETH focused. What are your guys' thoughts on the altcoin options space, and do you think that's maybe an edge that could be had in DeFi? What are your thoughts?
Yeah. So, I mean, obviously the inflows are coming from the ETF, and so it's very institutional, capital heavy. I think most of the activity in options today is dominated by, well, Deribit mostly, and it's mostly on Bitcoin and ETH. I think for alts, it's very situational. Like it kind of depends on, unlock schedules, really people hedging risk around that, vesting schedules. And also just like tactically positioning ahead of catalysts. So it's harder to find two-way liquidity, I would say, for options. I think usually you're facing a dealer that's like just delta hedging, which relies on a pretty robust perp market or borrow lend market. The one thing that coming out of the last cycle is we've seen just a collapse in the whole borrow lending kind of credit landscape. So there is just a lot less availability of borrow, and I think project treasuries and sort of like issuers are much more cognizant of like where their free float is going, and it's not freely lendable to people who are ultimately going to short it or whatever. So yeah, I think, and the other thing is I think probably a lot of people in this room know there's like this movement towards tri-party collateral and sort of like managing your counterparty risk in crypto, and for good reason, but that has severely constrained like capital, the capital efficiency of like trading derivatives. And just to piggyback on what the other panelists have said, I think there's a lot of lessons to learn for DeFi, like around how the CeFi market has evolved in derivatives, right? So like, why is Deribit so dominant? It's really because like everyone has capital there. It's like very hard, the opportunity cost is very high to move capital off of Deribit to another derivatives venue, especially if you're like a large dealer and you have a lot of open positions there. I think the one way DeFi fixes this is like you really should think about making your portfolio composable with other venues so that like you can net out risk between those venues. I don't think anyone's like gotten this problem correctly, and it does require a lot of like coordination, and frankly like everyone's kind of like fragmenting into different app chains and stuff like that, so that's really hard, and maybe that means there's always going to be a room for like a centralized kind of dealer or prime broker type entity that kind of sits in between, intermediates risk. But yeah, that's
I would just say that I would say the reason why altcoin options have typically lagged behind historically has really had to do with the development of the market. So I come from a commodities trading background where you have a physical end use case where you have 80 million barrels a day of crude oil being produced. So the Mexicos of the world, the Saudis of the world actually need to hedge their production. And so derivatives have an actual financial end use case, right? The evolution of derivatives in crypto has been dominated by retail speculation, where you had a global pandemic, you had people with a lot more time sitting at home with a lot more capital to inject, and that led to a frenzy of speculation. You saw that with how Robinhood gamified options trading, and that was kind of the first, I would say, major retail boom that you've seen in people trying to get leverage from a retail perspective as opposed to institutions. And so I would say that structurally led to perps, specifically for altcoins, becoming way more developed, way more involved, and just a first mover advantage more than anything. These days, I would say, although altcoin volumes have picked up noticeably, I would say they will still lag behind by leagues compared to majors, and that's largely driven by a lot of the flow is driven by ETF flow. And I wouldn't be surprised if over the next year or two you begin to see options on Bitcoin ETF, and then you begin to have traditional market makers that have been around for 2 decades come into that space and try and actually provide liquidity. And yeah, I would say that that's probably going to be more of the dominant trend force when it comes to derivatives, specifically in the form of options, as opposed to altcoin liquidity becoming very dominant for options.
Makes sense. And then from the protocol side, how do you guys view the altcoin option space?
From a protocol perspective, it's from a personal perspective, I will never short it, because there is no way I'm going to price that things right? And I think that's the same for the protocol perspective. Like we have an AMM right now at risk, and there is no way that we're able to price the implied volatility of something like that. From an order book perspective, the new product we have is an order book, and if there is anyone on the counterparty that is able to, willing to provide liquidity for it, why not, right? I'm definitely not against it, but the thing is, I probably at this point it's extremely hard to. I'm trying to think myself, how would you price the volatility of WIF in the last 3 days, options, right? So it's like, yeah, you can do it, but someone's going to get hurt. So I think that's the main issue about the altcoin. As I said, it's a completely new market, hard to price them. On the other side, Perp is very easy, right? You just want to long it or short it, you go there, you pay like 300% annualized funding rate, and simple as that, right? So yeah, that's the way I say it.
I was just going to say, the funny part about that is I would agree with you, where I would not necessarily want to go naked short wings on any altcoin per se, especially over the past few days. But the dominant flow that you typically begin to see in altcoins, especially when it's token projects, everyone is looking for yield wherever they can find, and covered calls is like the dynamic, or is the dominant form which people extract that, right? Whether it's in the form of structured products or what we call structured products in crypto, which we in TradFi would just call covered calls.
Yeah.
Everyone is typically of the nature of selling vol, and that tends to work until it doesn't. And so the question is, what is the incentive for people to go on the other side?
Yeah. We have actually few discussions with treasuries to do covered call on the, like treasury token, obviously, because it's there sitting, not having any yield, and, covered call is actually a good way to do it. There is a market on the other side. I haven't found it yet, to be honest.
If you do, let me know.
But yeah, that's probably the main thing.
Yeah, I mean, altcoin options are tough. Yeah, they're pretty expensive, and we saw a little bit of it. Like, people were trying to buy puts when Curve was dumping and unlock schedule. So there are some pockets, but it's not worth. We have an OTC product on chain, and we saw some flow, but it's really erratic, and it's not reliable. It's not worth investing time into at the moment, even as a standalone OTC, let alone an order book. I think. There's a protocol called Friction, and there were some others which were doing structured products on Solana, and they did phenomenally well for the same reasons that Ribbon did really well. They were selling sold covered calls, and those grew to 100 million TVL at least. And so people were selling, sold calls whether they knew it or not, and that was a lot. So I think the only way where altcoins options do well is if users don't even know that they're interacting with it. It's sort of packaged up and abstracted away in some sort of structured product like Ribbon or Panoptic. So yeah, that's the way forward, structured products.
Awesome. Thanks, guys. And we'll hop over to a more perp-focused question. So, Paul, we can maybe start with you. Is there still more room for innovation in perps, or are we kind of at an end state already? From my perspective, you've got pre-token launch perps, you've got perps with RWA implementations. What are your thoughts on the innovation in the perp markets?
Yeah, and I think it ties to the last question, because dYdX on a roadmap, we considered having different market structures and options and other asset classes, but I think there's a lot of room to happen on innovation in perps. I don't think it necessarily has to do with the market structure of perps directly, but rather product experience around how you trade perps. So the stuff around permissionless market listing I mentioned, retail onboarding, there's just so much improvement that could happen to exchanges. Performance, right? Performance improvements for market makers. I don't think anyone has an amazing performant chain. I think dYdX v3, I think Hyperliquid's doing pretty well in terms of performance. I'm not sure what the performance looks like on Aevo, but I'm sure the performance is pretty good. But I think there's a lot of improvement there just generally. So I don't know if it's necessarily in the market structure of perps, but I think in terms of protocol product innovation, that's where most of the innovation is going to come. But I mean, there are obviously perps on other asset classes that aren't digital assets that could be hosted in DeFi. Equity perps, for example, didn't really do well on FTX because I just think that crypto, digital asset native market makers weren't trading it yet. Equity native market makers just don't, they're trading in huge in equity markets. Why are they going to do it on DeFi, right? But I think if there's demand on the retail side, eventually you'll see perps and all these other asset classes as well.
Got it. That makes sense. And I guess a general DeFi question is sorry, losing the voice. Is the user experience and user interface kind of holding back DeFi adoption from retail for, I guess, everyone on the panel?
Yeah, I'd say yes and no. I think that there's a lot that could be done with UX, but I think generally like pro traders are the ones trading in these markets, and like most of retail just isn't aware of perps and like what it is, and it looks kind of daunting. So I think if you can dumb it down, like what perps are to retail, then we'll see like a huge influx. Yeah, I do think like to a certain degree, there's some onboarding friction, but I think the people who really want to trade are going to overcome that friction. And it's really just like introducing perps to like a new user base.
Yeah, I'd say actually the UX is like really quite good, at least on Aevo, like once you have a non-custodial wallet. So I think much of the friction is further upstream in the like account abstraction layer. I know some teams like dYdX and others are trying to abstract away all that, and I do like email stuff, all that. So I think that is where the UX is still sort of like rough around the edges. But I think once you're in, it's actually pretty good. Like there are improvements around stability and performance and like scam wicks, all of that. But I think like interacting with it, barring that, is actually in a pretty good spot at this point.
Yeah, I tend to agree. I made myself an account on a centralized exchange a couple of days ago for different reasons, and there was way more friction than using DeFi at this point. The problem is, like, I guess if we are thinking was like our users now are all like crypto native at this point, are definitely there are a lot of friction for new users that they're not crypto native to get in. But probably, as you know, I agree with what the guy said before me. Like when you think about who's making the most of the volumes right now, I think they even is coming like in our case, for example, through API and then stuff like that. So I think like the UX for the big user, for the power user, is there. So yeah.
I think from my perspective, like I think you guys covered the retail angle pretty well, but for larger like institutional users, there's still sometimes a gap in the DeFi space around like risk engine and sizing, doing large prints simultaneously. So like RFQ style type trading. So all these like UI things could be improved, I think, to service more of an institutional crowd. But yeah, I'd say the biggest thing is like running into unusual edge cases when you're trying to like put on spreads and things like that, and not taking into account the sort of like risk profile of a trade. And if you're a retail user, you probably wouldn't encounter that because you're just putting on like small, whatever $100,000 type trades. Yeah.
I would just say the cost of integration can sometimes be high, and as you have this fragmentation of liquidity, it's like, do I really want to integrate with 17 different protocols that might offer different pools of liquidity, but I don't have a central aggregation functionality? But I would say, like, more broadly, like UI UX has been a problem in crypto and Web3 for a very long time, right? Like it's you build this elegant architecture and background, but one of the coolest things that I encounter is when I go to Starbucks to pay for my overpriced coffee with Apple Pay, do I really know all of the steps that go into the background as to what allows that to happen? No, right? If a grandmother in Oklahoma wants to send her grandson Ethereum, it's like she has to create a wallet, have these 12 secret passphrases and do all of these things. And I would say overall Web3 and crypto has struggled with the adoption of people who are outside of the crypto native bubble. And I think that does extend into DeFi and derivatives as well.
Got it. Yeah, that makes sense. Paul, you kind of touched on it, and that is the user friendliness of some of these products and having to teach retail, okay, this is what an option is, this is what a perp is, this is what a funding rate is. What do you think can be done to provide more education on some of these products? Or what do you think is going to be like the defining factor to get retail trading options, trading more perps? What are your thoughts there?
Well, the easy answer is just educational content, but I honestly don't think that goes too far. I don't think like people are going to go online and read these things. I think they will to an extent. But I think perps, like if you've never heard of a perpetual swap, right? And then you hear that word, you're like, what is this? But I think it's like extremely easy to understand if you like take it through a first principles perspective. Like all it is this tracking correlation to an underlying price feed, right? And like finding a positive correlation that's like either like 1, 2x, whatever, or a negative correlation for short. It's a pretty easy concept to understand. So I think trying to understand more fundamentally what it is and kind of spreading the word on that. But I think over time, like it's like when DOS existed before the internet. And this is why I think pretty much most of the use cases in crypto are driven by speculation, right? Like even like Friendtech, the social platforms, is like up and down voting on a bonding curve. So like like when DOS existed before the internet, and there's no user interfaces. No one used the internet, and it seemed like huge, super daunting. But then there was like a use case in like Instagram or whatever, social media. People started to onboard. I think like as the lay user who doesn't really know what crypto is starts to like have speculation and maybe like more consumer facing speculation things, they'll start to realize things like perpetual swaps and come into the market. I mean, dYdX is very focused on like this pro trader and like people who are already trading in the market right now. We're looking at things like, embedded wallets and things to help this other user come on who doesn't really have a sense of like what crypto is yet. But there's not much like one specific like protocol can do to help this user who has no clue what a perpetual swap is. It's kind of like a timing thing of like when they onboard, start to realize there's value in speculation, it becomes more of a norm throughout society.
I think the best driver of education is FOMO. If the price is going up, they will really want to learn how a perpetual swap works. So yeah, I think that's the best way. People are greedy and people want to seek profits, and they'll go a long way to finding out what it takes to make a lot of money. So, and obviously that comes with, more education, but I think that'll be like the main engine as Bitcoin price goes up. Like we can, for the most part of it, like we can lay back and just let people come. Like I don't want to sound like complacent, but I do think a lot of it is going to come from just the price going up across majors and alts. And yes, obviously keeping on trying like create articles and working on that. But yeah, that's where I stand.
Yeah, I try to learn a lot about like how people actually, especially retail, like interact with options, for example, because that's the hard one. And something I realize is probably by design options are not made for crypto average retail trade, because I definitely agree with you guys. It's like market is going up and I have to figure it out the easiest way and the fastest way for me to get exposure to that movement up, right? And when they go to a perp, it's very simple. Like they say, okay, I have an edge. I think market is going up right now because I look at the chart or whatever. And what I want to do, I just want to get the max exposure out of it. So I click two buttons. I have two, like as a user, I only have to think about one thing, when to get in and like how much exposure I want. When it comes to option, it's completely different. Like the get in is like, okay, expiries, strikes, prices, like some might be underpriced, some like be overpriced. Like there is a massive difference between funding rate and the premium of the option. Like people look at the premium of the option, they don't look at the funding rate. I don't know any single trade, retail trade, that actually know how much you spend on the last trade. On the options, everyone knows how much you paid as a premium. So there is a fundamentally completely different, like in terms of psychology when you trade those instruments. So on the option side, what you need to do is just like, as I said, you either remove the complexity of the option with other products, structured products. That's how you can educate people. Or you really need to make sure that people want to like be nerdish with options. They want to figure out what's going on. They want to get into like Greeks and everything. So you either go very deep, or you just probably just give up and say, okay, just go trade a perp. It's easier. That's it.
Just to make a point there, though, sorry. So in equities, if you want leverage, you go and do options. In crypto, you have perps. So like, I'm not forced to, if I want leverage, I'm not forced to learn how options work. But I mean, during GameStop, all that craziness, people were forced to learn, like they're all buying zero DTs. Like they were learning like what strike to use, what expiry to use. Like they were forced to learn it because they wanted access to leverage. And when you have perps, it's kind of taking away that edge, like that USP from options. But yeah, people, again, the point is like, if they need to, they will learn. But in this case, they don't need to get leverage with options.
Also, the one thing I was going to add that I find kind of interesting is we talk about perps and we talk about altcoin options, but we don't talk about a dated forward curve or a futures market that exists, which you would think would be the next intermediate step, because it's like, what are you using to actually price altcoin options, because there's not a liquid dated forward market, right? And yes, you can use the perpetual funding rate and do a min-max 99% scenario and be super conservative or super aggressive, depending on if you're bidding or offering, or you can come up with some sort of supply emission model. But the lack of a dated forward curve or a futures market really is, I think, one of the more interesting phenomena that's observed in crypto, where you can have altcoin action and that's 6 months out, one year out. But if I ask someone for a price of, hey, where would you bid, Ondo 6 month forward, that's a very different question that's not necessarily as easily answered.
I think the problem is like you have these treasury deals that are pricing at like 50% below spot with like a long-term lockup, but then you have like the per funding rate at like plus 10%, right? So they go really wide bid offer. But yeah, like I think to your point of just like broader adoption, I think a big thing is just like the diversification of market participants, especially like institutionally. The like options become more useful when people think in multiple dimensions, right? So it's like I'm not just making money on spot price, but I'm making money on implied vol or theta or whatever. So the fact that there are more like kind of vol savvy people in crypto now is very helpful. People who are taking active views on, you know, the spread between like Bitcoin and ETH implied vol or something like that. And then also the emergence of, I think, more institutional people who are benchmarked to certain things, right? Like if you're benchmarked to Bitcoin and most of your portfolio is alts, then you're probably, like we have people who do this, they just buy like, you know, short dated calls on Bitcoin just to protect themselves from a dominance move. So stuff like that, where it's like you get more TradFi motivations for trading these options creates like a much richer market and allows you to transfer risk like more effectively, I think.
Awesome. And then quick 30-second final thoughts from each panelist. You know, where does everyone think the space is heading? Is DeFi going to take market share from CeFi? Is it continue to be CeFi dominated? Where does everyone think it's heading?
Yeah, I think pretty much all of us are taking a bet that DeFi is going to be bigger than CeFi, or at least start to eat market share. And I think that's true. I mean, there's a lot of beautiful aspects of DeFi, like ownership in terms of governance, protocol revenues. The self-custody aspect is pretty huge. And yeah, I think over time, we're going to start seeing better product experiences. We'll start to see DeFi look more like CeFi. And then the product improvements or the improvements of just the differences, like I just mentioned, such as the non-custody aspects, will start to drive people to DeFi. So yeah, really excited to see innovation. Like there's new exchanges popping up. dYdX has obviously been at it for like 3 or 4 years, but it's really cool to see these new exchanges like emerging in this cycle. It's definitely lighting a fire under our ass, and we're really excited to innovate on the product side, and yeah, really excited to see where the space goes.
Yeah, I mean, the whole idea is like people are using DeFi rails without knowing they're using DeFi rails. I don't think we're ever going to be in a world where everyone knows they're using DeFi rails. Like that is not going to happen. What's going to happen is people are going to be under the hood. It's going to be DeFi rails. We're going to have access to all these fundamental DeFi properties like composability and interoperability, which are going to enhance a bunch of the products, structured products being like the perfect like poster child of that. So yeah, but it has to be a sex experience. Like no one's going to have non-custodial wallets. Like that's not going to happen, at least knowingly. So that's the key. Like it's kind of a cringe term, but like CDFI is kind of like what I'm thinking about. Take the properties of like ease of onboarding and on-ramping of CeFi, but powered by DeFi. That's what I'm envisioning.
Yeah, I think the main point, as they shared earlier, is like if you want to really flip them, you need institutions at this point because that's what the volumes are, right? So, and right now we're not there in terms of many different reasons: the regulatory, compliance, margining, as we discussed, a lot of fragmentation. Can we go there? I guess we can, but I think I have to agree with Aevo on this. It's like we're gonna be to a point where institutions they're gonna need that compliance, right? So they're gonna use CeFi as or like SEXes, as a way to access to it, and then DeFi is just gonna be the tech behind. But as long as we have transparency, as long as we have on-chain settlement and everything, we're gonna get the best out of it, right? Because let's be honest, everything we want to avoid is another FTX. They don't want it, we don't want it. Like no one in the space want another FTX. So as long as you can offer like an experience that is a mix of the both, but you know where your money are, you have completely understanding of the settlement. You can see everything on chain. You can track everything there. You can access to all the data you want in a super transparent way. I guess that's the direction that we're taking. So to flip that. And then obviously there are going to be thousands of other applications. They're going to be not as friendly as institution, I guess, and that's the power of DeFi. And they're going to be like 100% DeFi, and we love that too, right? So I guess there are going to be a lot of different use cases and different targets, but to flip them, I think we need those guys that at some point they say, okay, we're just going to move everything to DeFi.
I kind of like the phrase CDFi. I'm going to start using that more often. CDFi, I was going to say, right? I was going to say, I feel what eventually is going to happen is as you begin to make transacting, whether on CeFi or DeFi, more easier for institutions, crypto, whether it's Bitcoin, Ethereum, or altcoin number 17 on CoinGecko, these will just become an extension of most institutional trading strategies, right? Whether you want to view Bitcoin as a commodity and trade WTI versus BTC, or you want to view it as an FX cross into Euro, or you want to trade relative value between Coinbase stock and Ethereum, like all of these things will just become natural extensions. And so I think what you'll eventually have is a convergence of traditional institutions and like Web2 corporations partnering with decentralized institutions and crypto natives, and you just have this kind of confluence of two forces coming together. And I think that is probably what the 5-year, 10-year story looks like. In the short, 12 to 18 months, I don't want to prophesize too much, but I expect both CeFi and DeFi will see a surge in volume as we enter the next stage of hopefully what is a remarkable bull market.
Yeah, I think what I'm most excited about is sort of bringing, kind of like what you guys said, bringing elements of DeFi into the centralized market, where you extract like the best parts of DeFi, which are basically like transparency and verifiability of collateral, balance sheet integrity, risk positioning. I think the biggest lesson maybe from the last cycle is that in a bull market and in a bear market, everything becomes like correlation 1 to some degree, right? Like I think everything is, even credit risk, it turns out, to exchanges and to counterparties just is a function of spot price at the end of the day, because everyone was just rehyping collateral. So I think, one of the things that we could do is, firms like GSR and like Arbelos, like we can be more responsible and disclose a lot more about our balance sheet and our trading activities and our risk positioning by participating more on DeFi and verifying exactly what our risk profile looks like.
Awesome. Thanks, guys. That wraps up the panel.